Hendri, an MBA student from IPMI. Welcome to this mind mapping video on corporate financial management, inspired by the teachings of Prof. Sembel. First of all, I want to share about the definition of corporate finance. So, what is corporate finance? Corporate finance is the area of finance that focuses on how companies manage their money. It covers how businesses plan investment, raise capital, manage their risk, and ensure financial healthy so they can grow and create value for their shareholders. The goal of corporate finance is optimal orchestration of internal and external financial resources towards significant and sustainable value creation. In this video, I will cover several topics, including inside-out perspective or as management of the company, outside-in perspective as an investor, business conduct, investment simulation and efficient market hypothesis, and what we have learned on this corporate finance class. First of all, I want to talk about the inside-out perspective, how company leaders think about value, growth, and long-term success from within the organization. At the heart of every business is one clear objective: create value. But value today is not just about profit, it's about sustainability. That's why we now focus on the triple bottom line: profit, people, and planet. To help us stay aligned with the goal, we use several key frameworks. We know that there is vacancy for cornerstone of value. The first one is core value principles, consists of return, growth, and cash flow. Second one is value conservation, perceive what we build. And the third one is best owner principle. It's allocate asset to whoever can make the most of them. The last one is expectation treadmill. It will stay ahead of market expectation. And then we also know we have Ramcharan's 5 business drivers, consists of cash, margin, velocity, growth, and customer focus. Simple, but it's very powerful to guide us for decision making. Now, what creates values within company? It's more than just physical resources. It's known as 6 sources of corporate value. We divide it into tangible and intangible asset. The first one is tangible asset, consists of land, buildings, and machineries. Also financial like cash and receivables. The second one is intangible asset, consists of people like skilled, motivated employees and reliable suppliers, networks like customer relationship, distributors and channels, organization consists of leadership, corporate value and strength system, and the last one is company reputation. In this economy, intangible assets often create more values than what appears on the balance sheet. But even with great assets, problems can arise, especially when managers' interests don't align with the shareholders. This is called the principal agent problem, and it leads to conflict of interest, asymmetric information, moral hazard, and adverse selection. Then, how to solve this? The first one, the company have to link compensation to company performance, offer stock options, enforce accountability, and implement good corporate governance, or we know as GCG. GCG is coming from Indonesia. It is guided by tariff framework. We know that is transparency, accountability, responsibility, independence, and fairness. We also use the ESG balance scorecard to balance value and impact. Like financial to create value for the investors, customers, quality and timing, internal process, efficiency and cycle time, and learning and growth, developing people and innovation. Let's move to managing asset and liability management as the second section. The first one is the capital budgeting. In this corporate finance class, we evaluate project using several parameters. The first one is NPV or net present value. It measures how much value a project adds today. Positive NPV make a good investment. The second one is IRR or internal rate of return. It's the return rate when your project breaks even, the higher the better. And PI or profitability index, when it's a value created per dollar of investment. Above 1 is worth doing. And then the payback period, it's how long it takes to recover your investment. We know that in this payback period, the shorter, the safer. Next one is the capital structure. We balance debt and equity using theories like Monligan and Miller and considering tax and benefit of debt and cost of financial distress. In tax and benefit of debt, debt provides tax benefit because interest payment reduces taxable income, lowering the company overall tax burden. And for the cost of financial distress, high debt level increase the risk of financial distress, leading to costs like bankruptcy and loss of business confidence. We all know that risk is a constant. That's why we need strong financial risk management. And sometimes, bold moves like restructuring are necessary. We learn from the real case, named the Nabisco LBO. The Nabisco LBO is a leverage buyout that completely transformed the company's direction. The Nabisco LBO demonstrated how leverage buyouts can generate high returns through debt finance acquisition, but also highlight risks like heavy debt burden and pressure on operational performance. Okay, finally, let's touch the dividend policy. Why do companies pay dividend? The first one is the tax advantages for major shareholders. The second one, as the important, is it's the part of signaling theory, where actions speak louder than words. A dividend often signals financial strength. So far, we have talked about the first section, value creation and financial decision making from inside the company. Now, let's dive into one of the core principles of corporate finance, the balance between risk and return as the opening of outside-in perspective or investor perspective. Let's start with the big idea, high risk, high return. In finance, we live by one golden rules. The higher the risk, the higher the expectation return. But not all of the risks are equal, and not all of them can be managed the same way. There are two main types of risk in corporate finance. The first one is systematic, and the second one is unsystematic risk. The systematic risk is market-wide risk you cannot eliminate, like inflation, interest rate, and political instability. And unsystematic risk is a company-specific risk, like losing a major customer, product recall, or supply chain breakdown. We know the popular quotes by Warren Buffett that don't put all your eggs in one basket. Now, let's look at the Hendri Fahrezi big idea. In the 1950s, Nobel Prize winner Hendri Fahrezi introduced modern portfolio theory. To understand the return an investor should expect, we use the capital asset pricing model or CAPM, developed by William Sharpe, also a Nobel Prize winner. CAPM shows that an investor should only be rewarded for taking systematic risk because unsystematic risk can and should be diversified away. Now, let's talk about time value of money. Here's a simple truth. Money today is worth more than money tomorrow. Why? Because money now can be invested and grow over time. That's the time value of money. Let me show you a quick trick to understand compounding. The rule of 72. It will estimate how long it takes to double your money based on a fixed interest rate. Next, let's talk about the methods of investment analysis. To make smart investment decision, we don't just guess, right? We analyze. Here are two main approaches. The first one is fundamental analysis, and the second one is technical analysis. The fundamental analysis looks at value behind the business, like economic analysis, industry analysis, and company analysis. Meanwhile, the technical analysis is about reading price movement and trading patterns. The last one is the financial statement analysis. First one is the balance sheet, profit and loss statement, and cash flow statement. But we don't only read, but we analyze them using the financial ratio consists of profitability, liquidity, activity, leverage, and market. To define the company is healthy or not, we also can use several measurements like natural level, quality of number, historical trend, industry benchmark, and decomposition, or we also know that DuPont analysis. For practical strategy, we also learn from experts by book review to understand better about various corporate finance perspectives. In the world of corporate finance, managing money is one thing, right? But protecting it from fraud, that's a whole different thing. Next, we are talking about a crucial topic for every business and organizations: fraud risk management. According to the experts, fraud happens when three things come together. The first one is opportunity, like weak internal controls or poor monitoring create loopholes. Second one is pressures. This could be personal, like debt, addiction, dissatisfaction with pay, or professional, like missing targets or losing bonuses. The last one is rationalization. Eliminate one side of the triangle will reduce the risk of fraud dramatically. The next one, we will talk about the investment fraud, the 7 financial shenanigans. Some companies manipulate financial reports to mislead investors. Here are the 7 red flags to watch for. The first one is recording revenue too soon, booking fake or inflated revenue, using one-time gains to boost revenue, delaying or accelerating expenses to manage earnings, hiding liabilities, deferring current income to the futures, and pulling future expenses into the current period. After we learn about the type of fraud, the last question is, how do we prevent fraud? So, here are 5 key strategies every organization should use. The first one is build a culture of ethics, design anti-fraud controls, train your employees, protect by IT systems with strong software, hardware, and access control, and enable whistleblower systems. It will give employees a safe way to report concern. In this class, we are also learning from movie. There are 3 movies: Others People's Money, Roach Trader, and Wall Street. From this movie, ethics in finance is not optional. It's the foundation of trust and long-term success. We are also learning from Michael Douglas, the iconic one in Wall Street. So, based on this movie and this class, we learned that greed is not just a negative. It has the positive sides for us. In this corporate finance class, we also conduct the investment simulation bi-weekly and efficient market hypothesis. In an efficient market, asset price reflect all available information. That means the price of a stock or bond is a fair price, neither too high or too low. You cannot consistently beat the market using that information because it is already reflected the price. The last one is what we have learned so far. The first one is learner-centered learning. In Prof Corporate Finance class, student is the center. So we are explore many various of ideas and learn from each of us. The second one is we are using the real-time data. It reflects the real life, right? Like the simulation and event analysis. It is hot and currently happening. The third one is diversity of assignment, like watching the video, creating multimedia presentation, debate, quiz, company analysis, until the fundamental and technical analysis. Then the structured and integrated assignment. And the last one is debate and discussion, like pros and cons, sharing knowledge, and real life experience and wisdom. Well, that's all of my mind mapping video. Thank you for joining me on this journey through this concept of corporate finance. Remember, successful finance is not just about the numbers. It's about people, strategy, and integrity. If you found this video helpful, don't forget to like, share, and subscribe for more insight. Until next time, keep learning and leading with confidence.